Now, by the end of June last year, Kenya's public debt soared to a record near $11 billion. And as the East African nation struggles to get back on its feet post a borrowing spree, which led to a surge in debt servicing costs, its government has decided to abandon its current lending program with the IMF, but it has approached the lender for a new loan program to take account of unused funds from the current program. Phumelele Mbiyo, senior macroeconomist at Absa CIB, joins us with more detail and insight into what this means for Kenya's fiscal position. Phumelele, thanks so much for your time this afternoon. And let's just start there. Why is the nation abandoning that program?
Well, in all likelihood, it's probably because of disagreements between the IMF and the government on the pace of fiscal consolidation that has been achieved under the program. What has been noticeable, especially in the current fiscal year, is that the government has eased fiscal policy quite substantially. Originally, they were planning to have a fiscal deficit of 4.3% of GDP, but the supplementary budget has increased that fiscal deficit to about 4.9%. And if you look over the last 2-3 years, there are other metrics that indicate that the fiscal position has been deteriorating. If you look at interest as a percentage of revenue, for example, it has been increasing to such a point now that interest expenditure is taking up close to a third of total revenues. So there might have been disagreements between the IMF and the government regarding the pace of fiscal consolidation and whether this is acceptable or not.
Talk to me about the impact this has potentially had on, let's say, investor sentiment when it comes to sentiment around Kenya, Phumelele.
So the announcement initially soured sentiment, but that proved to be short-lived because if you look at Eurobonds, they did sell off a bit. Yields on Eurobonds did rise somewhat, but that seems to have stopped. And the currency did also depreciate slightly, but that also seemed to have eased. I think what is going to be key for investors is going to be what the tone of the negotiations and the outcome of the negotiations between the IMF and the government are going to be over the coming year or so.
And let's get into that a new proposed deal that they have put forward. You write about 3 scenarios that expand on the outcomes of the negotiations. Just take us through that.
So, first of all, we don't know for sure what the outcome is going to be. First, and we don't even know, for that matter, what the government, what the nature of the program that the government is asked for. So there could be a finance program, it could be an unfunded program, it could be a standby arrangement as well. So we don't know for sure what kind of program the government is looking for. The scenarios that I laid out in the note that you are referring to, firstly, is that perhaps the highest probability scenario is that the negotiation between the government and the IMF take a long time. And in large part, that would be because there's an election that is coming up in 2027, August 2027, general elections. And generally, the IMF tends to be reluctant to start a new program going into an election. And this is particularly pertinent for Kenya because if you remember last year, the protests that broke out due to the finance bill, during those protests, you know, the IMF and its intentions were impugned by some of the protesters. So they might not be willing to have a program that is essentially going to start just before the election and then end after the elections in 2027. So that suggests to us that partly as a consequence of that, but also partly potentially because of very hard negotiations around the parameters of the program, it's going to take quite a long time for that to play through. Then there is still a possibility that another scenario could play out, that very quickly the government realizes that they have a problem with fiscal consolidation, and that they come to an agreement with the IMF very quickly, and within 4 to 6 months they could have a program. Then the third scenario, which we don't think is, which we think is the lowest probability scenario, is that the government and the IMF do not come to an agreement at all, and they announce very soon thereafter, and then the government tries to craft a fiscal consolidation plan on its own without the auspices of an IMF program. But we think that that is the lowest probability scenario that could play out.
So there just seems to be a lot of uncertainty as we don't know what may happen. And with that in mind, just how important is it for Kenya not to, let's say, have a fallout with the IMF, considering that the IMF's endorsement somewhat serves as, somewhat of a seal of approval, which also boosts, the country's credit worthiness, and perhaps maybe how it goes about trying to get alternative funding?
Well, it's important in several respects. I mean, first of all, it's important in ensuring that the government undertakes an economic program that is going to eventually stop the increase in debt levels and the increasing trend in interest expenditure taking up larger and larger proportions of government revenues. So it's important from that perspective, first of all. And then secondly, it's important in terms of increasing investor confidence and ensuring that as a consequence of that, the Kenyan government doesn't pay too high a price to borrow, not only in international market, but also in domestic markets as well. So in the event that there wouldn't be any agreement on a funded or an unfunded program, for that matter, with the IMF, then you could see as a consequence of that capital flows coming into Kenya could decline, and that could have repercussions not only for the currency but for the ability of the government to obtain funding. It could lead to interest rates rising, for example, making it more difficult for the government to actually achieve its fiscal consolidation goals.
Phumelele, thanks so much for your time and just sharing your insights on Kenya's debt picture. That was Phumelele Mbiyo, Senior Macroeconomist at Absa CIB.